January 27th, 2025. A single day that might be remembered as the moment America's AI dominance died. Not with a bang, not with a war, but with a $5.6 million research project from a Chinese startup nobody had heard of a week ago. On that Monday morning, Nvidia lost $589 billion in market value. Read that again. $589 billion gone in one day. That's not just the largest single-day loss in stock market history. That's more than the entire market value of all but 13 companies on Earth. That's more than double Meta's previous record loss of $240 billion. NASDAQ dropped over 3%. The entire tech sector, the foundation of American economic dominance for the last 2 decades, hemorrhaged value. And here's what should terrify you. This wasn't a flash crash. This wasn't panic selling over nothing. This was Wall Street waking up to a reality that's been building for years. China just proved they don't need America's permission to win the AI race. They don't need our chips. They don't need our capital. They don't need our approval. And they sure as hell don't need our timeline. Let me take you back so you understand what actually happened here. For the last 3 years, the United States has been executing what Washington calls strategic decoupling. The policy is simple. China is our primary geopolitical rival, so we cut off their access to advanced technology. In October 2022, the Biden administration banned exports of advanced AI chips to China. Nvidia's H100 and A100 chips, the backbone of AI development, couldn't be sold to Chinese companies. The logic was straightforward. AI requires massive computational power. Computational power requires advanced semiconductors. If we control the semiconductors, we control who can build cutting-edge AI. National security, they called it. Protecting American technological leadership. And it worked, or so everyone thought. Chinese tech companies scrambled for alternatives. They stockpiled older chips. They tried to work around the restrictions. But the consensus in Silicon Valley and Washington was clear. Without access to the latest hardware, China would fall behind. Maybe 5 years behind, maybe 10. They'd never catch up because the gap would keep widening as America kept innovating. Then on December 26th, 2024, a company called DeepSeek released something called DeepSeek V3. DeepSeek is a Chinese AI startup founded in 2023 by Liang Wenfeng, a hedge fund manager, not a tech giant, not a state-backed enterprise, a 1-year-old startup. And V3 was good. Really good. On par with OpenAI's GPT-4, Meta's Llama, Google's Gemini. The kind of performance that American companies spend hundreds of millions of dollars and years of development to achieve. But here's where the story gets interesting. DeepSeek claimed they built V3 for $5.6 million. Not $500 million, not $100 million, $5.6 million. Using 2,000 Nvidia H800 chips. H800s aren't even cutting edge. They're the export-compliant version Nvidia created specifically to bypass US sanctions. Less powerful, less capable, not the H100s that everyone said were necessary for advanced AI. And DeepSeek did it in 2 months. Most of Silicon Valley dismissed this as impossible or exaggerated. Chinese propaganda, some said. They're lying about the costs, others claimed. There's no way you can match GPT-4 for $5.6 million when OpenAI spent over $100 million training their model. Then on January 20th, 2025, DeepSeek released R1, the reasoning model that changed everything. R1 wasn't just good at pattern matching or text generation. It could reason. It could solve complex problems. It could perform multi-step logical operations. Third-party tests showed it outperforming OpenAI's O1 model in several categories. And it was free. Open source. Available to anyone. By January 23rd, DeepSeek's app hit #1 on Apple's App Store, pushing ChatGPT to second place. Not just in China, globally. That's when Wall Street started paying attention. January 27th. Markets opened and the bloodbath began. Nvidia dropped 17%, the largest single-day decline since March 2020 during the COVID crash. Broadcom fell 11%, AMD down 6%, Micron down 10%. ASML, the Dutch company that makes the machines to manufacture semiconductors, dropped nearly 7%. The entire AI infrastructure story that Wall Street had been betting billions on suddenly looked fragile. Here's what spooked investors. The American AI boom has been built on a simple premise. Training cutting-edge AI requires massive amounts of computational power. That means buying thousands of high-end Nvidia GPUs. That means building enormous data centers. That means consuming huge amounts of electricity. That means spending billions, tens of billions on infrastructure. Microsoft, Google, Meta, Amazon, they've all committed to this model. Microsoft alone announced plans to spend over $80 billion on AI infrastructure in fiscal 2025. Google, Meta, similar numbers. The entire tech sector has been pouring capital into GPUs, data centers, power generation, all predicated on the assumption that more compute equals better AI. DeepSeek just said, maybe that's not true. Maybe you don't need to spend $100 million training a model. Maybe you can do it for $5.6 million. Maybe you don't need 10,000 cutting-edge GPUs. Maybe 2,000 mid-range chips are enough if you're smarter about how you use them. And if that's true, if AI development can be done at a fraction of the cost everyone assumed, then what exactly have American tech companies been spending all this money on? Mark Andreessen, one of Silicon Valley's most prominent venture capitalists, called DeepSeek's achievement one of the most amazing and impressive breakthroughs he's ever seen. He compared it to the Soviet Union's Sputnik launch. That's not hyperbole. That's Silicon Valley realizing they just got outplayed. Now, let's talk about what this means for the broader US-China economic relationship, because this isn't happening in a vacuum. This is happening in the middle of what might be the most consequential economic conflict since the Cold War. In 2024, during his presidential campaign, Donald Trump floated the idea of 60% tariffs on all Chinese goods. Not 10%, not 20%, 60%. That's not a negotiation tactic. That's economic warfare. And he wasn't joking. After taking office in January 2025, the Trump administration ramped up trade restrictions. In February, new semiconductor export controls. In March, expanded tariffs on steel and aluminum. By April, the trade war had escalated to the point where the U.S. was imposing 145% tariffs on Chinese goods, and China was retaliating with 120% tariffs on American products. Then in May, both sides blinked. Trade talks in Geneva resulted in a 90-day pause. The U.S. dropped tariffs from 145% to 30%. China reduced theirs to 10%. Both sides agreed to scrap some non-tariff measures. But here's the critical detail. One of China's key demands in those negotiations was the resumption of AI chip exports. They wanted access to Nvidia's H100s and H200s. The U.S. refused. National security concerns, they said. We can't let China build advanced AI capabilities that could be used for military purposes, so the restrictions stayed in place. And China said, fine, we'll do it ourselves. DeepSeek is the result. Not a government project, though you can bet the Chinese government was watching and supporting from the shadows, but officially a private startup using export-compliant chips, building world-class AI without American permission. And now the US has a problem, because the entire strategy of using semiconductor export controls to slow down Chinese AI development just got proven ineffective. If DeepSeek can build competitive models with mid-range chips, then cutting off access to high-end chips doesn't accomplish the goal. It just forces China to get better at optimization. And that's exactly what happened. Here's how they did it. DeepSeek didn't try to match American companies in raw computational power. They couldn't. They didn't have access to the hardware. Instead, they focused on efficiency. They used a technique called mixture of experts, which activates only the most relevant the model for each query instead of running the entire model every time. They optimized their training algorithms. They used clever data preprocessing. They made their code more efficient. It's like the difference between someone who wins a race with a more powerful engine versus someone who wins by being more aerodynamic and using less fuel. Same result, different method. And in AI, maybe the efficient method is actually better because it's cheaper to run, faster to deploy, and more accessible. Now let's talk about the immediate aftermath, because this crash isn't over. It's just beginning. In the days following January 27th, multiple analysts tried to calm the markets. Bernstein's Stacy Rasgon said the panic was overblown, that DeepSeek didn't really build OpenAI for $5 million, because the stated costs don't include all the prior research and experimentation. Futurum's Daniel Newman argued this is actually bullish long-term, because more efficient AI means wider adoption, which means more compute demand overall. Nvidia itself issued a statement calling DeepSeek's work an excellent AI advancement and a perfect example of what's possible with export-compliant technology. But here's the problem with all these reassurances. They're missing the point. Wall Street isn't panicking because DeepSeek built a cheap AI model. Wall Street is panicking because America's perceived lead in AI just got cut in half overnight. For 2 years, the narrative has been that the US is 5 to 10 years ahead of China in AI, that China's authoritarian system stifles innovation, that without access to American chips and American capital, China can't compete. DeepSeek just proved that narrative was wrong. Not slightly wrong, completely wrong. And if the narrative was wrong about AI, what else is it wrong about? For the last decade, American economic policy has been built on a set of assumptions. The US controls the cutting-edge technology. The US sets the standards. The US can use access to American markets and American technology as leverage. Allies need our protection. Rivals need our chips. Everyone needs dollars. But what happens when those assumptions stop being true? What happens when China can build competitive AI without American chips? What happens when they can do it cheaper and faster? What happens when American companies can't compete on cost because they're locked into an expensive infrastructure model that assumed no alternatives existed? Let's look at the companies that got hammered. Nvidia, obviously, but also Broadcom, Micron, AMD, ASML, all the semiconductor companies that supply the hardware for AI. Also Oracle, Vertiv, Constellation Energy, all the companies building data centers and power infrastructure for AI. All of them are predicated on the assumption that massive computational power is necessary. If that assumption is wrong, if efficiency matters more than raw power, then billions of dollars of capital expenditure might be wasted. And it's not just tech. This has implications for energy. AI data centers are enormous electricity consumers. Microsoft, Google, Meta, they've all been buying up power generation capacity, making deals with utilities, planning for exponential growth in energy needs. If AI can run on less power, those investments look questionable. It has implications for commercial real estate. Data centers require massive physical footprints. If you need fewer servers to run equivalent AI, then the demand for data center space drops. It has implications for American competitiveness. If China can produce AI models at a fraction of the cost, then Chinese companies can undercut American firms in global markets. Why pay for ChatGPT when DeepSeek is free and just as good? And here's the geopolitical dimension. This isn't just about business. This is about power. AI is being called the most important technology of the 21st century. Whoever leads in AI leads economically, militarily, and politically. The United States has been acting like AI leadership is a birthright. Billions in investment, the best universities, the most talented engineers, the biggest companies. All of that should add up to dominance, right? But what if it doesn't? What if a more efficient approach beats a capital-intensive approach? What if China's model of focused government support plus entrepreneurial innovation is more effective than America's model of private sector-led development? DeepSeek suggests that might be the case. Now, let's talk about where this goes next, because there are 3 possible scenarios and all of them are bad for someone. Scenario 1. The trade war escalates. Trump takes DeepSeek as proof that export controls aren't working and decides to get tougher. More restrictions, more sanctions, attempts to cut off China from any advanced technology, not just chips. China retaliates. They limit exports of rare earth minerals, which are critical for electronics manufacturing. They target American companies operating in China. Apple, Tesla, Nike, Starbucks all get squeezed. Supply chains that took decades to build get torn apart in months, and both economies suffer. The US loses access to Chinese manufacturing capacity. China loses access to American markets. Global trade contracts. Everyone gets poorer. This is the lose-lose scenario, and it's the one Washington seems most committed to pursuing. Scenario 2. The AI race goes into hyperspeed. DeepSeek proves that open-source, efficient AI can compete with proprietary, capital-intensive AI. Other companies adopt similar techniques. The entire industry shifts toward efficiency over raw power. This could actually be good. More accessible AI means more innovation. Smaller companies can compete. The technology spreads faster. But it also means the massive investments American companies have made might not pay off the way they expected. Nvidia's dominance gets challenged. Data center operators face overcapacity. The winners aren't the companies that spent the most money, but the companies that were the smartest about optimization. And that might not be American companies. Scenario 3. Strategic decoupling accelerates. This is the one that worries me most. The US and China stop pretending they're going to find a compromise and just split. Not completely, but enough. American companies pull out of China or get forced out. Chinese companies get banned from American markets. Technology standards diverge. The world fragments into competing tech spheres. The US sphere includes Europe, Japan, South Korea, Australia. The Chinese sphere includes much of Asia, parts of Africa, Latin America, and everyone else has to choose sides. This isn't hypothetical. This is already happening. Look at TikTok. Look at Huawei. Look at semiconductor supply chains. Companies are being forced to choose. You can operate in the US market or the Chinese market, but increasingly not both. And when that happens, the global economy that's been integrated for 40 years starts to unravel. Trade decreases, innovation slows, costs increase. And the biggest loser is everyone who depends on that integrated system, which is all of us. Here's what you need to understand about why this matters beyond just tech stocks. The American economy has been built on a specific model for the last 50 years. We design, we finance, we consume. Other countries manufacture. China became the workshop of the world. America became the innovation center. That arrangement worked because America controlled the cutting-edge technology. We had the patents, the software, the chips, the platforms. China had the factories, the labor, the supply chains. But they were always one step behind technologically. That gap was the source of American leverage. But what happens when that gap closes? What happens when China can innovate at the same pace or faster? What happens when they don't need American technology transfer because they're developing their own? DeepSeek is a signal. Not the only signal, but a very loud one. It says China is no longer playing catch-up. They're competing head-to-head, and in some areas, they might be pulling ahead. Look at electric vehicles. BYD, a Chinese company, is now the world's largest EV manufacturer, surpassing Tesla. Look at 5G infrastructure. Huawei's technology is competitive with or superior to anything Western companies produce. Look at solar panels. China produces over 80% of the world's solar panels, and they're cheaper and often better than alternatives. Look at batteries. Chinese companies dominate lithium-ion battery production. Look at drones. DJI, a Chinese company, has 70% of the global consumer drone market. And now look at AI. DeepSeek just proved China can compete at the cutting edge. This is the pattern. In industry after industry, China starts by imitating, then improves, then dominates. And the American response has been to try to slow them down through restrictions and tariffs. But what if that doesn't work? What if instead of slowing down China's development, it just forces them to become more self-sufficient? That's exactly what's happening. When the US banned Huawei from using American chips, Huawei didn't collapse. They invested billions in developing their own chips. When the US restricted AI chip exports, Chinese companies didn't stop developing AI. They figured out how to do more with less. Every restriction creates an incentive for China to build alternatives. And once they build those alternatives, they don't need American products anymore. And then those American companies lose the Chinese market permanently. Let me give you the numbers on what that means. Apple gets 17% of its revenue from China. That's $63 billion annually. Tesla gets 21% from China. That's $21 billion. Nike, around 15%. Starbucks, 11%. These are massive American companies that are deeply integrated into the Chinese economy. And they're all vulnerable. Not because China necessarily wants to kick them out, though that's possible, but because if US-China relations keep deteriorating, if the decoupling accelerates, these companies will be caught in the middle, already happening. In 2023, Apple's revenue from China fell 10% from $24 billion to $21 billion. Tesla's market share in China dropped from 7.7% to 4% in early 2024, as Chinese EV competitors took share. Nike reported declining sales in China. The trend is clear. American companies are losing ground in the Chinese market, and the Chinese market is too big to lose. China is the second largest economy in the world, on track to become the largest within a decade. It's 1.4 billion consumers. It's a huge market for everything from iPhones to coffee to sneakers. American companies need access to that market to grow. But access requires Beijing's permission, and Beijing's permission requires political accommodation, which the US is increasingly unwilling to provide. So here's where we are. DeepSeek triggered a $589 billion market crash. But that's just the visible part. The invisible part is the realization that American technological dominance is not inevitable. It's not guaranteed. It's under serious challenge. And the policy tools the US has been using, export controls, sanctions, tariffs, they're not working the way Washington thought they would. China is adapting faster than the US is tightening restrictions, and every time the US tries to slow China down, it makes China more determined to become self sufficient, which makes them more competitive long term. It's a vicious cycle for America and a virtuous cycle for China. Now, let's talk about what happens next because this is just the beginning. In the next few months, we're going to see more developments that test this dynamic. First, watch how American tech companies respond. Do they double down on expensive infrastructure? Or do they shift to more efficient models like DeepSeek? If they shift, billions of dollars of planned capital expenditure might get canceled or delayed. That impacts Nvidia, data center companies, power companies, everyone in that supply chain. Second, watch US-China trade negotiations. Trump and Xi met in South Korea in late October 2025 and agreed to a temporary trade truce. But that truce is fragile. If Trump sees DeepSeek as evidence that restrictions aren't working, he might push for tougher measures. China will retaliate. And the spiral continues. Third, watch Chinese tech stocks. After the initial crash, Chinese tech companies actually rallied. The MSCI China Index was up nearly 14% year to date as of mid-February 2025. Why? Because investors realize that if Chinese companies can compete in AI without American chips, then maybe they're better investments than people thought. That's a major shift. Fourth, watch American manufacturing and supply chain policy. There's been a lot of talk about reshoring, bringing manufacturing back to America or at least out of China. But that's expensive and slow. Apple has been trying to diversify manufacturing to India and Vietnam. It's not going well. China's supply chains are so well developed, so efficient, that replacing them is nearly impossible in the short term. So American companies are stuck. They need China to manufacture their products. But they're worried about geopolitical risk, and they're caught between Washington's demands to reduce China exposure and Beijing's threats to retaliate if they leave. Fifth, watch how other countries react. America's allies, Europe, Japan, South Korea, they're watching this very carefully. Do they follow America's lead and restrict technology exports to China? Or do they see an opportunity to fill gaps the US is leaving? Germany's been quietly maintaining ties with China. European companies are still investing there. Japan's been more cautious but hasn't completely cut off relations. Everyone's hedging. Because everyone knows that a world divided into American and Chinese spheres is worse for everyone. But nobody knows how to stop it from happening. Here's the bottom line. January 27th, 2025 wasn't just a market crash. It was a revelation. It revealed that the assumptions underlying American economic and technological strategy are flawed. China isn't dependent on American technology the way Washington thought. China can innovate independently. China can compete head to head. And in some areas, China might be better at it. Not because they have more money or more resources, but because they're forced to be more efficient. Restrictions created incentives, and those incentives led to innovation. DeepSeek isn't an anomaly. It's a signal of what's coming. More Chinese tech companies finding ways to compete without American inputs. More Chinese innovations that challenge American dominance. More erosion of the technological gap that's been the foundation of American power for 50 years. And here's what terrifies me. This is happening faster than anyone in Washington expected. 5 years ago, the consensus was that China was 10 years behind in AI. Now they're competitive. 5 years ago, people said Chinese EVs couldn't compete with Tesla. Now BYD is outselling Tesla globally. 5 years ago, people said China couldn't build advanced chips without ASML's machines. They're trying, and they're making progress. Every prediction about how long China would take to catch up has been wrong. They always do it faster than expected because we keep underestimating them. We assume they can't innovate, only imitate. We assume authoritarian systems stifle creativity. We assume that without access to American technology, they'll fall behind. All of those assumptions are proving false, and the cost of being wrong is massive. Not just economically, strategically. If China becomes the dominant technological power of the 21st century, if they set the standards, if they control the supply chains, If their companies dominate global markets, then the world order shifts. American influence declines, Chinese influence rises, and that has implications for everything: trade, security, human rights, global governance, everything. So, what do you do? If you're an investor, you pay attention. The tech sector is going to be volatile. Companies with heavy exposure to AI infrastructure might struggle if the efficient model beats the capital intensive model. Companies with exposure to China are at risk if the trade war escalates. Diversify. Hedge. Don't assume the last 5 years of tech dominance will continue unchanged. If you're a business leader, you plan for multiple scenarios: full decoupling, partial decoupling, managed competition. Make sure your supply chains can handle disruptions. Make sure your market access doesn't depend entirely on one country. If you're a worker, you pay attention to which industries are vulnerable. If your job depends on technology that China can replicate cheaper, that's a risk. Upskill. Adapt. Stay flexible. If you're a citizen, you demand better from your leaders. The current strategy of restrictions and tariffs isn't working. It's making China more self-sufficient, not more dependent. Maybe it's time to try something else. Competition instead of containment. Innovation instead of restriction. Actually being better instead of just cutting off the competition's supply lines. Because here's the truth nobody wants to admit. The United States is no longer the unquestionable technological leader. We're still ahead in many areas, but the lead is shrinking, and it's shrinking fast. DeepSeek proved that. A one-year-old Chinese startup using mid-range chips, spending $5.6 million, just built an AI model that competes with anything American companies have produced after spending billions. That shouldn't be possible, but it happened. And if it can happen with AI, it can happen with other technologies. That's what January 27th revealed. Not just a market crash, a shift in the global technological order. America is still powerful, but no longer dominant. China is still behind in some areas, but closing the gap faster than anyone expected, and the race is far from over. We're watching the beginning of a technological Cold War. Two superpowers competing for dominance in the technologies that will define this century. AI, semiconductors, quantum computing, biotech, space, energy. Winner take all, or at least winner takes most. And right now, the winner isn't clear, which means the next few years are going to be turbulent. More market volatility as investors recalibrate who's ahead. More trade tensions as both sides try to protect advantages and close gaps. More supply chain disruptions as companies are forced to choose sides. More geopolitical friction as the technological competition bleeds into military and political domains. This isn't ending, this is just beginning. DeepSeek was the first shot. There will be more. Count on it.